Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
U.S. payrolls marked down by most since 2009 in preliminary data. It sounds important to me. Let's go to Ira Jersey. He's the bond guy. He covers U.S. interest rate strategy for Bloomberg Intelligence. He's down in, I'm going to guess Princeton, New Jersey. Why come to the world's financial market, God forbid. Ira, thanks so much for joining us. You're the expert on this stuff. I'd love to talk to you about this U.S. payroll data and about Jackson Hole. How are you kind of writing about this in your BI research?
Yeah, the data, I think, Paul, is was more or less what a lot of people had expected. You know, kudos to our colleagues over at Bloomberg Economics who saw a number very similar to this, negative 818,000 for the revisions. Keep in mind, this is old. This is going to be revised again, and also it's not information that's new, right? So if we think about all that this means is that, yes, the data was weaker and the economy was weaker between April of 2023 and March of 2024. That doesn't necessarily tell us where we are now or where we're going over the next couple of quarters. And but it does show that maybe things weren't quite as rosy as the preliminary data suggested.
And Ira, I'm glad you brought that up because Paul and I were talking about a story I wrote ahead of that data, and it was just to that point where options traders weren't pricing in a big swing because they really saw this as backward looking, as basically a non-event for the stock market. We were seeing the S&P 500 still higher this morning. But when it comes to the bond side of things that you focus on, what is speculative positioning telling us in the bond market ahead of Powell speaking at Jackson Hole on Friday?
Yeah, I don't think the positioning really hasn't changed a whole ton over the last couple of months. And, speculators are still relatively, less short than they used to be, but they're still generally short rates. But that's because, real money investors are long, right? So for every long, there's a short in futures positioning. So you have to keep that in mind. And a lot of those shorts are going to be against other things, right? So people who are long credit or people who are trying to delta hedge options positions, for example. So all of those things go into some of that futures positioning. So you can't take as much away from that one data set as you can from, say, just the incoming data that we get. In terms of Jackson Hole, I think that the one thing that this data that we received just a couple of minutes ago does suggest is that that the Fed has more ammunition to cut interest rates. People who are worried about them cutting 25 or 50, the market kind of is now back in terms of the first cut being maybe 25 basis points. But this does give them some ammunition because they can say, oh, well, the economy is not as strong as we had thought, and because of that, that gives us at least a little bit of comfort in the fact that we can slowly start to reduce the amount of monetary tightening that we've done.
All right, Jackson Hole, Wyoming. Is it better for Fed Chairman Jay Powell to just keep it short and sweet and just let things keep moving?
Well, it's. Yeah, that's a good question. We get the minutes today at 2:00, so I think that he's going to stick to almost whatever is said in the minutes. So I think it's going to be very important to kind of read what a majority or most of the members of the Federal Reserve had said at the last meeting. But I suspect that he is going to hint that the Federal Reserve is on a path to cutting interest rates, but he's going to remain. And I think if you recall from his post-meeting press conference, he still said, like, look, we haven't made any decisions. We're doing everything. We're doing everything meeting to meeting. But when you look at a preponderance of the data, I know the retail sales data last week was pretty decent, but a lot of the other data that we're getting is mixed to somewhat lower. And certainly today's employment data suggests that things aren't as rosy as we had thought. And because of that, I think that he's going to hint that a cut is on the table.
Looking at the 10-year Treasury yield trading just below 380, what's the key levels when you're looking at the 10-year or the 2-year right now?
Yeah, so 378, so not too far from where we are right now, is a reasonably important technical level on the 10-year yield, and below that you're talking about somewhere in the 360s kind of area. 364, I think, is the next big level. Interestingly, we've kind of over the last couple of weeks, and since I left on holiday, we've been in a more or less a range, and because
right.
of that range, you've seen momentum indicators suggest that maybe we're going to stay in that range until we get something big that's going to knock us out of it.
All right, Ira, thanks so much for joining us. Ira Jersey, he's a chief U.S. interest rate strategist for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I tell you, one of the stocks today, again, really jumps out at you is Target. Our friends at Target put up a solid quarter here, and the market loves it. Stock's up 13%, which, again, for a retailer of that size to have that kind of a move in a stock really kind of jumps out at you.
Another one I'd point out, too, TJX.
Yep.
Up 5%, trading at an all-time high,
that?
also on the back of strong results.
Let's check in with an expert on this stuff. Jen Bartashus, she's Bloomberg Intelligence Senior Analyst. She covers all that retail stuff. I'm not really sure what's going on there, but she's the expert. So, Jen, talk to us about Target. What are they doing right there?
Good morning. Thanks for having me. And with Target, what we're really seeing is that they sort of reaffirmed their strategy around creating newness, reducing prices, and enhancing the value perception they have with customers. And this second quarter results, we really see that is starting to resonate, especially because they're seeing traffic going back into stores as well as online. So really, positive early signs from Target that this momentum might be able to continue.
What about when it comes to consumer packaged good companies? Because you and I have talked in the past, and we know that Richmond Fed President Tom Barkin watches price to mix very closely, and that's a lot of the data that you crunch over at Bloomberg Intelligence as far as what that means for inflation and also the direction potentially for Fed policy. What are you seeing on there as we begin to get more consumer packaged good companies reporting as well?
Well, what we're seeing is obviously there's political, pressure with a lot of rhetoric going on right now about the need to lower prices. We're seeing retailers like Walmart, like Target, like Kroger, like Albertsons pushing back on packaged food companies who are, in some instances still looking to push through some selective price increases. So there is that tension that's happening kind of behind the scenes. But overall, we're seeing prices on the shelf starting to come down, and that spells relief for consumers. It's just a matter of how long it takes for them to actually recognize it and appreciate it and reward it with higher volumes that they're buying.
What's Target saying about the consumer? What are the other retailers that you talk to, Jen, you follow? What are they saying about the consumer today? Because I think as investors, we kind of feel like we're getting mixed messages about the consumer.
Yeah, I think when you're talking about the staple space, which is, where these companies that I follow fall, it's that the consumer's not getting worse. They're not necessarily getting better, but they're sort of holding steady. And part of that is that we've had some consumers who kind of trade down into those middle tier stores, or even to some of the discount stores in order to save a little bit of money. So the companies in this space are pretty well positioned because they do well no matter what the economic circumstances are. And I think that's showing through with the results. But they're saying, consumers are spending, but it's still very thoughtfully. And so the things that will attract them to spending is your merchandise mix, your newness, your convenience, the quality, things that will then tempt them into spending the dollars that they're managing very carefully.
We only have about a minute left here, but you've talked a lot about how you're expecting more consumer packaged good companies to roll out promotions in the second half of the year, like buy one, get one free, buy one, get one 50% off. What are you seeing so far with that as far as what companies are saying on these earnings calls?
Yeah, promotions have definitely accelerated, and we are back at sort of the levels that we were at before the pandemic. What's interesting is most of these companies say that they're able to be more precise, so that it's not just a blanket offer like you used to see on the front of an insert or a mailer, but they're sort of targeting promotions to customers based on what they buy. So they're able to preserve a little bit of profitability and still offer higher discounts. And so I think that's a pattern that we're expecting to continue through the second half and probably into 2025 as well.
Hey, Jen, thanks so much for joining us. As always, really appreciate getting a few minutes of your time. Jen Bartashus, she's a senior analyst at Bloomberg Intelligence, covering all the retail space, one of the real leaders on Wall Street, providing research analysis on the retail space, talking about Target today.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Jess, someplace I really want to go that is way off the beaten trail, and I probably couldn't even get anybody to go with me, Santa Fe, New Mexico.
Oh, I've never gone to Santa Fe.
Looks very, very cool. And there's some cool people from there.
A little Bloomberg Intelligence trip.
I think so.
Over.
But now I think I might have a reason. Our next guest is from Santa Fe, so we can go out and visit our good friends at Thornburg Investment Management. Emily Leveille, she's a portfolio manager. How she ever got to Santa Fe, New Mexico, I'm sure there's a story there. Emily, thanks so much for joining us from Santa Fe, New Mexico. What are you making of this market here, Emily? I mean, we started 2 weeks ago, Monday, a crazy, crazy day, a big sell-off in the market, maybe some panic in the market, I guess. But boy, we seem to have found our sea legs since then. What do you make of this market?
It's been really interesting, hasn't it? I mean, yeah, two and a half weeks ago, it felt like the bottom was falling out, and we've really seen a recovery in the strength of the market in the last couple of weeks, a return of that momentum factor, which I think is a really important indicator of, where the market goes from here, and some pretty decent data as well. I mean, I remember part of that weakness was some of the data that came out, and then since then we've had, pretty decent data on retail figures, some better data on jobs numbers, and I think now everyone's looking ahead to the Fed, and then obviously what's going to happen in September, and I think it's just really going to be data dependent from here.
And we were just talking about, Emily, how some of that BLS data on the annual revisions through the year ended through March were delayed. But if you look at this, U.S. employment rose about 1.3% in the year through March of this year, BLS is saying as well. And then also I was looking at Goldman Sachs was talking about how the release so far points to a downward revision in the realm of about 70,000 jobs per month. So waiting for that full release here. But wanted to pick your brain because this is obviously backward-looking type data. Also, Goldman Sachs, their economics desk, was pointing out how when it comes to, because they're looking at wages and claims data, so it won't include undocumented workers. So there's about potentially up to 1 million of them that wouldn't be included in this data. So when there's a lot of jitters about, say, the July slowdown in payrolls, which is obviously just 1 month of data, we haven't seen a trend yet. And looking at how the market's reacting, the S&P 500 still higher. It seems like options market wasn't really pricing in a big move here. So what's your kind of view here when you're looking at obviously more backward looking data, and does this really shape anything, and how much does it really tell us about the labor market?
Well, I think, from memory, 70,000, a monthly revision of about 70,000 jobs was a little bit on the lower end of, on the higher end of what the market was expecting. I had in my mind something between 30 and 50,000, based on some of the estimates from the sell side. So a little bit weaker, I think, and, probably one of the larger revisions we've had in the last decade. So we definitely think that we're in the later stages of an economic slowdown. I think this data probably confirms that. We're seeing employment growth slow in the U.S. I think that's normal considering the big moves in rates that we've had over the last 2.5 years. I think it's unrealistic that you go from 0% to 5.5% rates without any changes in the labor market and, sort of aggregate demand figures. So I think it's reasonable. I think we're in the later stages of a cycle. We see that in some of the mixed consumer data that's coming out as well. I don't know that it's going to change anything about, how the Fed acts. I think they have to thread this needle between, being proactive and data dependent, but not seeming to panic. And so I think it probably, we still get 25 basis points of cuts in September. Probably we get a couple more through the end of the year. But I don't know that this data really changes dramatically what Powell is going to say on Friday.
Emily, you are the co-portfolio manager of the Thornburg International Growth Fund. Where do you guys,
Correct.
Internationally, where do you see opportunities outside of Santa Fe?
Well, it's so interesting you say that. We're almost international here. We used to be part of Mexico, but one of the things that that we've noticed in this sell-off is, while the S&P is just a touch off of all-time highs, international markets haven't recovered quite as significantly from the sell-off. So the Nikkei, still off about 10% from its all-time highs. Some of the markets in Europe as well. And as growth investors, we're really focused on finding the opportunities that are going to be able to grow earnings power throughout an economic cycle. So we actually see some pretty interesting opportunities that have been provided to us by the recent volatility. So we still like the AI theme. We get a ton of exposure in high quality businesses that are key to this infrastructure build out outside of the United States. So companies like ASML in the Netherlands, like Disco in Japan. There are a number of these semi-cap, TSMC as well in Taiwan. These semiconductor and semi-cap equipment companies are core to this build out. Another area that we really like and where we see some strong long-term winners in international markets is in the healthcare space. So we have Novo Nordisk, we have AstraZeneca. These are really best-in-class, high-quality businesses that are now trading, well off their all-time highs, particularly in the tech space. And then the other thing that's kind of interesting about what we've seen in the last few weeks with, the recent moves and the pricing into the Fed cut is a weakening of the U.S. dollar. And what we like to tell our clients, especially as international investors, as you really might want to think about diversification outside of the U.S. The Mag 7 has dominated, obviously, in everybody's minds, and Mag 7's up 38, 40% year to date. But we've got companies outside of the US that give investors diversification that are up even more than the Mag 7 this year. We affectionately dub two companies in Latin America, New and Meli, the Mag 2 of Latin America, and they're up a combined 51% in US dollar terms year to date.
And you were mentioning the S&P 500 being a whisker away from that all-time high. If you look right now, Paul, the S&P is about 0.9 away from that July 16th closing high after falling as much as 8.5% after that drawdown that we saw earlier this month. So Emily, I'm curious because I know you were mentioning how you were managing this growth fund. What are you advising clients to buy? What do you basically suggesting them to sell after we saw such a big drawdown, but then a huge bounce back?
Yeah, it's been a wild ride. As we were commenting at the beginning of the show, we really focus on building a diversified portfolio. So we talk about, diversifying those sources of growth. And definitely what we're looking for right now are what are the businesses that can grow earnings power regardless of what's happening with GDP. So we talked a little bit about AI and that CapEx build out. We think that's going to be pretty resilient and insulated, not totally immune, but pretty insulated from, what's going on in the broader macroeconomy. We also think healthcare and some specific areas of healthcare. So, we're big holders of Novo Nordisk. We think GLP-1s have a tremendous runway for growth. There are almost 1 billion people suffering from obesity today. And when you look at the number of people that have been treated by GLP-1s for obesity at this point, we're in the tens of millions. So, that's going to grow. That demand is going to grow regardless of GDP. Another area that we really like within healthcare is ocular health, cataract surgery, a company, Alcon, that just reported yesterday. They're the leaders in cataract surgery and contact lenses globally. And again, demand for cataract surgery, that just grows with an aging population. So in as much as investors can get diversification of growth and earnings power that is dependent not on GDP, we think that is sort of a wise area to be focusing on at all times, but particularly now when, there's a lot of mixed messages. I mean, we were talking earlier about the consumer in the United States. You've had pretty mixed data from companies in the consumer space. In general, I think pointing to a consumer trading down, looking for value for money. And so, we're really being cautious in the consumer space and focusing on those areas of growth where we find businesses that can continue to grow their earnings power through a cycle.
Hey, Emily, thanks so much for joining us. Really appreciate getting your thoughts this morning. Emily Leveille, she's a portfolio manager, Thornburg Investment Management, joining us from Santa Fe, New Mexico. I'm putting that on the bucket list. I'm going there.
Let's do it.
It looks cool.
Keen to go
while
with
you were
this?
talking to Emily, I was Googling all through about Santa Fe, New Mexico, not paying attention at all. It looks very, very cool out there in the desert.
Be a lot of fun.
It's got a big arts community and so on. But
maybe we wait till it gets a little bit cooler and then
maybe,
we go in the fall.
because it is in the middle of the desert. But it seems like a pretty cool place to be. And I don't know any money management firms out there other than Thornburg Investment Management. I know there probably are, but that's reason enough itself to go check it out.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get back to those earnings coming out of the retailers. Macy's, TJX, Target, a whole bunch of stuff coming out there. Mary Ross Gilbert, she joins us. She's a senior analyst for Bloomberg Intelligence covering retail. She's based in Los Angeles. So, Mary, let's start with Macy's here. It just seems like, maybe one or two steps forward, one step back. What did you take away from Macy's earnings here?
Yeah, so as with any turnaround, and here we are in another iteration of trying to get growth back for this, it's the largest department store, Macy's. They did show traction in the first 50 stores. The comps were up 1%, and that was an improvement from the first quarter, which was up just less than 1%. But the fact is that the rest of the go-forward stores were down 3.7%. This is on a comparable basis, and it's owned plus licensed. So it includes licensed brands that they'll have, within the mix there. So they're showing traction in those little stores, but with the rest of the base, being very weak. And as they pointed out, they weren't really getting the conversion. What they're finding is you bring in salespeople. Wow, that's really if you think about department stores and where they came from, that's what they were known for in the past, was service. But over the last couple of decades, the service and the salespeople have sort of left the stores. Now they're finding if they bring them back, and they bring back the relevant brands, because one of the things that Tony Spring, CEO of the company, indicated is having newness and having the relevant brands that consumers care about. That's where you can get the impulse purchases. And so they're finding bringing in like a Karl Lagerfeld or a Vecla Fee, which is it's like a Parisian, a chic Parisian type brand. It's a U.S. brand, but it has that Paris streetwear aesthetic, and that's resonating really well, and they're getting very strong conversion. So bringing back service levels, bringing back the relevant brands is really making a difference in those 50 stores. So they're going to add another 100 stores where they're going to bring in service and handbags. They did see some strong sales with handbags again in those stores with the Ralph Lauren brand. So that's where I think you're going to see some improvements, is just really better signage, cleaner stores. We've been seeing those improvements in the store that we frequent. They just need to take it across the rest of the base.
And this seems like an about face, because just in May, when we had heard from Macy's previously in their prior earnings report, they had beat estimates, also raised the company's outlook for the remainder of the year. But as you know, this latest report comes on the heels of the company turning down that close to $7 billion buyout offer from one of its shareholders, Arkhouse, and of course its partner, Bridgegate Capital Management. Do we have any indication of whether or not that could be back on the table at some point?
I don't know if that'll be back on the table. I really think that they weren't able to demonstrate financing. I think that was the problem with that. And I also think that the price was low, because even though Macy's is showing very weak results right now, and the market is showing investors don't really like what they're seeing in the quarter, it's one quarter. And it's going to take time before we see real traction. So a year from now, the story could look very different if they're really able to execute on this plan, closing the stores. They haven't closed the stores yet. They're going to close the first 55. It was going to be 50. They upped it another 5 stores, are going to close at the end of the year. They always wait until after the holidays, because that's when they generate the most cash. And then, of course, they're going to close another 100 stores over the next couple of years, but again, they might accelerate that. So it's going to take time to show traction. So we'll see how the third quarter and fourth quarter go, especially with some of the changes that they're making to these incremental stores. But nonetheless, you can see who's gaining, and it's on the off-price side.
Right.
That's where, of course, we have TJX numbers out today, and
of
course they beat.
Yeah, let's go to TJX, owner of TJ Maxx. Stocks hit an all-time high today.
Right.
What's TJX? What are they getting right?
What they're getting right is they have all those brands. They have the treasure hunt. There's fresh merchandise in those stores every week. And the brands range from the very high end. So they'll have Gucci and Chloe handbags. And then they'll also have like Anne Klein. So they're sort of covering all of the demographics with their assortments, and they're making it relevant by store. They have the winning formula. This is an expertise that they have built up for years, and they're the largest out there. It's a $56 billion in sales company. And so in their quarter, of course, they beat with a 4% comp sales, and the consensus was 2.7 and guidance 2.2. sort of in that 1 to 2% or low single digit range. And of course,
Yep.
they raised their guidance. They're now expecting comp sales to be sort of in that 3 to 4% range, and they raised their EPS by about 6 cents.
Yeah, really solid results, all-time high for the stock. As you mentioned, Mary, they really got it right. Mary Ross Gilbert, thank you so much for joining us. Mary Ross Gilbert is a senior equity analyst. She covers retail for Bloomberg Intelligence. She is located in Los Angeles, California, joining us via that Zoom thing. So good news for TJX.
That's right.
Not so much for Macy's.
No, still on pace, but holds these losses. Worst day in about a year.
Okay, very good. We'll keep on top of that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Menton, she's sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. Boy, the auto industry is pulling back big time from the EV business. I mean, the latest news today, Ford Motor Company scraps electric SUV in a $1.9 billion hit to its EV ambitions, canceling the fully electric 3-row utility vehicle. Spending on EVs will drop to about 30% of CapEx from 40%. Steve Mann joins us here. He's the global autos analyst for Bloomberg Intelligence. He's down in Princeton, New Jersey. Steve, what's going on with the legacy auto companies and their transition, if there is one, to EVs? What's going on?
Yeah, it's a huge kind of 180 turn for Ford. You remember, they were probably one of the first Western automakers to actually introduce EVs. You remember the Mustang Mach-E, the Ford 150 Lightning, and they're still selling well, but I think they're actually bleeding quite a bit of money. In the last 12 months, they've lost $5 billion on EVs. So, I think they need to revisit and see, instead of a market leader in EVs, they probably needs to, step back and maybe become a follower until the market recovers.
And just looking at its stock, Paul and I were talking about this earlier. The ticker symbol is F for Ford. When you see the drawdown that it had from that peak that we did see earlier in July, it dropped as much as actually 33%. Now it's about still a ways from that peak that we did see. But what is it that shareholders really need to hear in the messaging from Ford in order to turn that stock around?
Yeah, a couple of things. So, like today, the stock is really not reacting to this news. I think what the investors are looking for is really similar to what GM and Stellantis has done, which is buy back stock. They want to hear that they're gonna, use some of that cash that they're conserving from cutting back R&D and buy back some stock, return some of that to the shareholder. So, I think that's why the stock hasn't moved that much today in reaction to this news.
All right, Steve, this kind of goes to the heart of the matter, I think, for me and probably a lot of investors in this auto industry is what really, at the end of the day, is consumer demand for EVs. Is it fair to say it's not as much today as maybe the industry thought 2-3 years ago?
Yeah, I think the estimates out there in the past were probably a little bit frothy. Like we're actually expecting, penetration to be around 25, maybe 30% by 2030. But other estimates out there were like 50, 75% penetration rate by 2030. It's a little bit too aggressive. I think we're just coming back to reality from the hype we have. But the other thing is there's a lot of competition out there, right? The Chinese are really looking to, compete with the legacy automakers on cost, on technology. And, that brings up another question that I think investors have in their mind is this the right strategy for Ford? To step back at this moment? Should they be doubling down, right? Investing more and really compete at a global level. So, so hopefully that answers your questions.
And you've written about, too, when it comes to Ford and the rising inventories, as well as the increasing price competition when it comes to a profitability headwind here. What do we know as far as what the rest of the year could look like when it comes to those earnings calls that executives have talked about?
Oh, there's a lot of risk in the second half. I think we're heading back to pre-COVID levels, with the supply chain smoothed out. They're ramping up. They have been ramping up production, and at the same time, interest rates are still high. Right? There are talks about cutting interest rates to help out the consumers, but we haven't seen that yet. And it probably needs more than a couple of cuts before we get to a point where a consumer gets more excited about buying a much more expensive vehicle today than it was 3 years ago. Average price for a vehicle is $50,000 now. It's not 35, it's not 40, it's 50,000. So, monthly cost is a lot higher for consumer. The cost of acquisition, the cost of ownership is much higher today than before.
All right, Steve Mann, thanks so much for joining us. Really appreciate it. Steve Mann, global autos analyst for Bloomberg Intelligence. He's down in Princeton, New Jersey. Appreciate getting a few minutes of his time there on Ford, kind of backing away to some degree from its EV ambitions.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.